final exam consists of 4 parts, 3 of which you have already covered in the course. Part 4 includes futures and a swap interest rates. That is new from week 9, but I will cover it so that you're not totally alone when you're doing the final exam. Part 1, we're looking at a 3D printer costing $365,000. This is a discounted cash flow calculation in which you're going to run the cash flows for the payments. Basically, what you're going to be doing is you're offering a payment plan in which you put 10% down, and the rest is financed over 24 months at $15,000 a month. So your cash price is the total price, the down payment is 10% of the cash price, monthly payment is $15,000. So the cash price minus the down payment is basically the loan that the user of the 3D printer is giving you. That's a positive cash. And then after that, the 24 monthly cash flows are negative payments, negative cash flows because you're paying them out. You run the ARR function and make sure that you analyze it, multiply it by 12, and then you calculate what is the implicit cost of credit. You have to compare that implicit cost of credit to the 7% cost of capital for JPM and decide whether or not it's worth taking this payment. Part 2, we're doing the evaluation of another company, okay? And basically what we're doing is something very similar to what we already did earlier in the course. You have to gin up sales forecast. You have to put in the expenses based on these costs, which are a percentage of the revenue for the year. Then you take the sales minus the sum of these 3 expenses, you get operating income. So you have to net out wages and benefits, aircraft and fuel costs, and general administrative to get operating income. On that operating income, you pay 21% in taxes. Then operating income minus taxes gives you net income after tax. You're good to go. Then you make the cash flow adjustments, adding change in working capital and the CapEx to get the net cash flows. Then are going to run your terminal value using the perpetuity formula with a 6.5% discount rate and a 2.5% long-term growth rate. Then you're going to run those cash flows using the present value function, the NPV function. Add cash, subtract debt, you get the value of the equity. That should do the job for part 2. Part 3, we're looking at some bonds. You're given coupons, par value, and the market discount rate for the bonds, and then you're going to run the coupon payments as cash flows, and you're going to use the NPV function to calculate the price. This is for bonds A, B, C. For bonds D, E, F, and G, you're given the coupons, you're given the par value, and you're given the prices. So you're going to run the IRR function on the cash flows, which are the coupon payments, so you can back into the yield. Remember, all the payments are semi-annual, so you have to make adjustments to the discount rate for the price to make it semi-annual, and for the yields, the IRR has to be semi-annual. Finally, in part 4, we're using the option pricing model, which you already used when we did real options. So all you have to do is put in stock price, risk-free rate, and volatility, and the numbers will calculate themselves automatically. So the true new parts are here in this section on futures. So you're going to have to calculate how many gallons per contract, number of contracts. Then you're going to have a contract price and a spot price. The profit or loss is going to be the spot price minus the contract price times the number of gallons. That should do it. Part C, it's a swap. And what you're doing is you're going from fixed, 150 million over 7 years, paying a fixed rate of 3.5%, which you're going to put here. These are all fixed payments, to floating, in which you're going to be paying a spread over 1.4% over these forecast rates for the Bloomberg short-term bank yield. So these floating numbers will be here, and you'll compare the two, okay, using the formula given, and you're going to add them all up as undiscounted, and then you're going to run the NPV function and discount these nets to show the discount net, and then you're going to determine whether or not you should take the floating